The U.S. national debt has surged by $444 billion in the last 2 weeks. If this rate continues, the U.S. will add approximately $11 trillion to the national debt each year. This alarming pace raises concerns about the potential for a sovereign debt crisis and a crisis related to the U.S. dollar. The primary cause of this issue is a decade of reckless government and corporate spending, financed by accumulating debt. Low interest rates, set by the Federal Reserve, contributed to this accumulation, enabling the government to pay only the interest on the debt. However, interest rates are no longer near zero. The prime rate has reached 8.5% and long-term Treasuries are approaching 5%. This sudden increase in interest rates is problematic because the debt has reached levels that can't be easily repaid. Furthermore, while the government has attempted to combat inflation, it has not resulted in more savings, but instead more spending. People are spending more, but they are buying less due to the higher prices caused by inflation. This inflation tax is affecting everyday expenses. The government's recent announcement of an additional $9 billion for student loan debt forgiveness also raises concerns, as it increases the national debt and may lead to more inflation. The situation is exacerbated by the fact that Americans have a high level of credit card debt and low savings. This further highlights the financial strain on households. To protect one's wealth, experts recommend diversifying investments, including investing in assets like gold and silver, holding foreign assets, and reducing exposure to the U.S. dollar. This is crucial as the inflation tax is expected to continue increasing in the coming years. A record percentage of adults who are still living with their parents have college degrees but cannot afford to live on their own. This situation is partly due to the burden of student loans that many have taken to acquire degrees. They are paying interest on these loans, leaving them with insufficient funds to cover rent, while the cost of rent is increasing. This trend highlights the challenges in the labor market, where even 30-year-olds struggle to earn enough to live independently. Moreover, there is a growing number of parents moving back in with their adult children, driven by financial difficulties as their retirement savings have been eroded by inflation. This consolidation of households reflects a declining standard of living and indicates the weakness of the labor market. In the September jobs report, there was an increase in employment, with around 336,000 jobs created. However, many of these jobs may be part-time, low-paying service sector jobs or government positions. A record number of Americans now have multiple jobs, emphasizing the weak labor market. Furthermore, the unadjusted numbers for September reveal a loss of 885,000 full-time jobs, the largest drop in 1 month since the initial COVID-19 lockdowns in April 2020. To compensate for these losses, a significant number of part-time jobs were added. The tragic events in Israel, there was a limited reaction in the financial markets. Initially, S&P futures were down, and Dow futures were down about 200 points, but they later closed up, which suggests market complacency. The stock market's ability to rebound from earlier losses. The stock market experienced a rally even after an initial drop in response to spikes in yields following the non-farm payroll report. Oil prices initially rose due to the events in the Middle East, but did not make as significant a move as expected. Despite the volatility, the oil prices remained within a certain range. Gold and silver both experienced a reversal, where they took out the low from the prior day and closed above the prior day's high. This suggests a potential end to the downtrend in these precious metals. The financial markets are not fully comprehending the heightened risks associated with the situation in Israel, which could potentially have an impact on the oil market. The ongoing situation and potential involvement of Iran are seen as significant factors. A comparison with Russia's invasion of Ukraine in 2014, which many experts initially believed would be resolved quickly, but ended up being a long-drawn conflict. This highlights the uncertainty of geopolitical events and their impact on financial markets. The status of the U.S. strategic petroleum reserves, highlighting that the country may be running low. This raises the question of how the U.S. would handle an oil embargo during a time of geopolitical unrest. The United States' relationships with oil-exporting nations are evolving, and the recent events could escalate tensions. For instance, the sanctions on Russia have pushed Saudi Arabia closer to Russia and China. The situation in the Middle East could further complicate these relationships. Stocks have performed well, primarily because the expectation is that nations involved in conflicts will buy more weapons. This could lead to increased arms sales, potentially funded by the U.S. The financial markets might be reacting to the situation in the Middle East with a sense that it could lead to more quantitative easing, QE, from the Federal Reserve. The markets may believe that bad news is good news because it could result in further QE given the uncertainty and instability in the region. Some economic assumptions are changing. Previously, many Many investors expected the Fed to cut rates and use QE in response to an economic recession, which was seen as a way to combat inflation. However, the expected recession has not occurred, leading to the unraveling of this trade and rising long-term yields. Bond prices are falling, and yields are rising, primarily because of rising inflation and a stronger economy. This is happening at a time when budget deficits are expanding, even in a strong economy, which is a different scenario than what is typically observed. Wars can disrupt supply chains, which can lead to increased prices and shortages for various goods and services. This disruption further impacts the economy negatively. Wars are expensive and divert resources away from civilian production. Contrary to some Keynesian economists, wars do not inherently benefit the economy by boosting GDP. In the short term, the economic cost of war outweighs the benefits. The situation in the Middle East, combined with already bullish factors, is likely to drive oil prices even higher. The ongoing war in the Middle East and the challenges it poses for the U.S. economy, including inflationary pressures, disruptions to supply chains, and the potential need for increased government spending to support military efforts and associated costs. The potential oil price increase may have far-reaching consequences for the economy. Rising oil prices could be the tipping point that officially pushes the U.S. economy into a recession. A recession would exacerbate already substantial budget deficits. They're Great Society kind of guys, advocates of the Peace Corps, welfare, Medicare, Medicaid, Social Security, and other government programs, which are still big backers of a big social welfare state. One similarity between Robert F. Kennedy Jr. and Ron Paul is their apparent sincerity and genuineness. While they may have their differences, at least they believe in what they're saying, unlike many typical politicians who are perceived as dishonest. Robert F. Kennedy Jr. has announced that he will run as an independent candidate, and it is expected that he will garner votes as an independent. The key question is whether he will achieve a high enough level of support to participate in the presidential debates, akin to Ross Perot's inclusion in the 1992 debates. Kennedy could draw votes away from both Democrats and Republicans, and his presence in the race may disrupt the dynamics of the 2024 election. Robert F. Kennedy Jr. could be more appealing to disgruntled Democrats who are not satisfied with the current administration. He may be able to siphon off votes from Democrats, making it easier for the Republican candidate, potentially Donald Trump, to win. There is a chance that Kennedy could attract some independent voters as well, but it is expected that more Democratic voters will be swayed by his candidacy. While the election may bring political changes, it may not significantly impact the economic challenges the United States is facing. A second term for Trump may not lead to the type of optimism and growth seen after his initial election in 2016. The ongoing crisis and concerns about inflation and government spending may persist, regardless of who is in office. Additionally, geopolitical tensions and potential conflicts in the Middle East could further exacerbate the economic situation. The performance of Bitcoin and the U.S. dollar. He notes that Bitcoin has lost its previous ability to respond significantly to global crises or economic events. Furthermore, despite rising interest rates, the U.S. dollar's response has been relatively muted, indicating a shift in the market dynamics. The lack of a substantial rally in Bitcoin and the modest gains in the U.S. dollar suggest that market conditions have changed, and traditional assets may regain favor as safe havens. In conclusion, the United States is facing significant challenges on multiple fronts. The soaring national debt, rising interest rates, and the threat of a sovereign debt crisis are causing growing concerns. The inflation tax is affecting everyday expenses for many Americans, and economic pressures are leading to changes in household living arrangements. Geopolitical events in the Middle East are adding another layer of complexity to an already fragile economic landscape. While political developments, such as the potential candidacy of Robert F. Kennedy Jr., may impact the upcoming elections, they may not provide a quick fix to the economic issues at hand. As the U.S. navigates these turbulent waters, it's crucial for individuals to consider diversifying their investments, exploring assets like gold and silver, and holding foreign assets to safeguard their wealth in the face of ongoing uncertainty. Thank you for watching, and stay tuned for more insights and analysis on the evolving economic and geopolitical landscape.